Every 4 years, Bitcoin's heart beats slower. It is not a poetic metaphor. It is the literal execution of cold, hard code. While most investors pop champagne celebrating the programmed scarcity that drives prices up, they often ignore the elephant in the room. This mechanism is a countdown to zero. When the mining reward eventually vanishes, the primary incentive to secure the network disappears with it. This is not just a technical adjustment. It is an existential risk that could silence the entire network. You need to look beyond the green candles and understand the machine itself. Today, we are not speculating on next week's price. We are conducting a stress test on the future of digital value. We will dissect the halving mechanism, analyze the brutal economics of the supply shock, and evaluate the 4 specific lifelines that could keep the network alive after 2140. This is the difference between blind faith and calculated conviction. Let's determine if Bitcoin is truly designed to be indestructible. You often hear people talking about Bitcoin cycles as if they were mystical events, predicting price movements based on vague feelings or hype. It is easy to feel lost when trying to understand why a digital asset would suddenly become more valuable just because time has passed. But you need to realize that this is not random chaos. Unlike the money in your bank account, which loses value at the whim of a central banker, this asset follows a strict, unchangeable schedule that no human can alter. At its core, the halving is simply code acting as law. When the network launched, miners earned 50 bitcoins per block. In 2012, that dropped to 25, then 12.5, and so on, until today's 3.125. This is the absolute opposite of the fiat system you are used to. While governments print currency to solve short-term political problems, Bitcoin mathematically tightens its belt. It does not care about the economy or your feelings. It simply executes the protocol. Think of this mechanism as a relentless digital metronome ticking in the background of the internet. It is an hourglass where the neck gets narrower every 4 years, allowing fewer grains of sand to pass through regardless of how hard you shake it. This invisible engine drives the entire narrative of the asset. It transforms what could have been just another copy-paste digital file into something that mimics the physical properties of gold, making it harder to extract the deeper we dig. The consequence of this design is profound because it removes the greatest risk to your wealth: human error. In traditional finance, inflation is a hidden tax levied by those with the power to print. Here, the supply schedule is transparent and immutable. You know exactly how many coins will exist in 10 years, which is a certainty that no national currency can offer. It forces the market to adapt to the asset, rather than the asset bending to satisfy the immediate demands of the market. Understanding this clockwork allows you to stop reacting to daily news and start planning for decades. You are looking at a system designed to outlast its creators. However, knowing the schedule is only half the battle. We must now look at what happens when this unstoppable force meets the immovable object of market reality. This leads us directly into the economic earthquake that occurs when the supply suddenly dries up while the world is still hungry for more. It is easy to look at the charts and assume that a halving is just a guaranteed party for everyone involved. You see the countdown and expect instant riches, but you might miss the silent panic happening behind the scenes. For you, the investor, this event signals potential growth and excitement. But for the miners who actually power the system, it is a brutal 50% pay cut overnight. This disconnect creates a dangerous noise in the market that can easily lead you astray. The logic here is deceptively simple, yet most people get the equation wrong. They think scarcity alone creates value, but that is a myth. Scarcity without demand is just nothingness. The magic only happens when the flow of new coins slows down, while the world's appetite for them remains constant or grows. We saw this play out perfectly in 2012, 2016, and 2020. The price exploded not by magic, but because the sellers simply ran out of stock while buyers were still lining up. Imagine the Bitcoin market as a massive reservoir that feeds a thirsty city. The halving is like a giant steel gate slamming down, instantly cutting the incoming water flow by half. The city's thirst does not vanish. People still need the water. As the reservoir level begins to drop, the panic to secure what remains intensifies. It creates a frantic pressure cooker environment. This isn't a gentle adjustment. It is a violent constriction of supply that forces the price upward. This constriction forces a ruthless survival of the fittest among the miners themselves. While you watch your portfolio grow, they are fighting for their lives. Only the most efficient operations with the cheapest electricity can survive the shock. This purges the weak hands from the network, leaving only the strongest to secure the blockchain. It effectively hardens the entire system, making the asset more robust and resilient against attacks as the price eventually stabilizes. Your job is not to blindly bet on the shortage, but to watch the demand side of the equation closely. If people stop wanting Bitcoin, the supply shock means nothing. You must verify that the world still values this asset before you commit your capital. But even if demand holds strong today, there is a much darker shadow looming on the horizon. We have to ask what happens when the faucet runs completely dry and the hard cap of 21 million coins is finally reached. You have likely heard the maximalists chant the mantra that there will only ever be 21 million coins. It is a comforting thought that promises infinite value growth, but it also triggers a quiet anxiety in the back of your mind. You wonder what actually happens when the music stops. It is the elephant in the room that few dare to address directly. We celebrate the scarcity, yet we ignore the very real possibility that this hard limit could eventually become the network's fatal flaw. Here is the brutal reality of the protocol. Bitcoin relies entirely on mercenaries, not volunteers. Miners burn massive amounts of electricity because they are paid in new coins. When that subsidy hits zero in the year 2140, the guaranteed paycheck evaporates. Without that incentive, the validation of transactions stops. And without validation, the security model collapses. The paradox is that the very scarcity making you rich today creates a revenue crisis for the guardians tomorrow. Think of the network as a fortress protecting an immense treasure. Currently, the walls are manned by an army of elite guards because the king pays them a daily salary from the royal vault, but the vault is finite. We are slowly approaching a day when the last gold coin is paid out. If the guards are not paid, they will abandon their posts, leaving the gates wide open for looters. The fortress does not fall because the walls are weak. It falls because the defenders simply walk away. This scenario challenges the assumption that Bitcoin is inevitable. We treat it as digital granite, but it is actually a delicate biological organism that needs constant feeding. If the incentive structure fails, the ledger dies, and your holdings become worthless strings of code. This is the Achilles heel of the entire project. The scarcity is the engine of value, but it is also the brake on security. We are racing toward a cliff where the rules of the game will fundamentally change forever. You do not need to panic, but you must understand the stakes to assess the long-term risk. This is not a problem for next week, yet the market is already pricing in the solutions today. The network must evolve from a subsidized startup into a self-sustaining economy before the clock runs out. We need to identify exactly what will replace the block reward. There are two specific lifelines being built right now that could keep the lights on, starting with the controversial rise of transaction fees. You might look at high transaction fees and feel frustrated, wondering why anyone would celebrate a congested network. It is natural to see these costs as a bug, something to be fixed. But what if I told you that this pain is actually the cure? The fees you dislike are the first pillar of the bridge that carries Bitcoin across the chasm. You need to realize that without a robust fee market, the security model we rely on would simply crumble into dust. The logic is straightforward when you strip away the emotion. As the block subsidy fades to zero, transaction fees must rise to fill the financial vacuum. We saw this with ordinals. People are willing to pay a premium for block space, but the solution goes deeper. Miners are evolving from simple coin hunters into essential energy partners. In places like Texas, they are paid to balance the power grid, turning the act of mining into a public utility. Imagine the network acting as a giant global shock absorber for the energy sector. When a power plant produces too much electricity, miners soak up the excess like a sponge, preventing waste. When the grid is stressed, they shut down instantly, releasing power back to homes. This symbiosis turns Bitcoin into a battery that stabilizes the physical world. It is no longer just digital gold. It is the concrete foundation of modern energy infrastructure. This evolution makes the network incredibly difficult to kill. If miners are stabilizing national power grids, governments cannot ban them without hurting their own stability. High fees ensure security remains absolute, while energy deals subsidize the operational costs. It creates a system where the network survives not because of ideology, but because it is practically useful. The asset becomes embedded in the real world, securing its own future through utility. You must stop viewing fees as a nuisance and start seeing them as the heartbeat of a mature system. A cheap network is a weak network, and we cannot afford weakness. However, fees and energy contracts are only the first line of defense. There is a more powerful force at play, driven by the entities with the most to lose. We need to examine the final safeguard, the massive institutional actors who will refuse to let the system fail due to self-interest. We started by looking at the halving as a simple price catalyst, but you now understand it is the heartbeat of a living organism. It is not magic. It is a mechanism that trades immediate security for long-term scarcity. We walked through the economics of the supply shock and the hard truth about the 21 million cap. You have peeled back the layers of hype to see the machinery underneath. The question is no longer just, number go up, but how the network evolves to survive. This distinction matters because the market is designed to slaughter the ignorant. While the crowd chases green candles based on blind faith, you are now operating with the clarity of first principles. You realize that Bitcoin is not held together by hope, but by brutal incentives and self-interest. True conviction comes from understanding the risks, not ignoring them. When the volatility eventually hits, you will not panic like the tourists. You will stand firm because you know the math. If you value this level of analysis over the noise of the mainstream, consider joining us here. We do not sell dreams. We dissect reality to give you an edge in a chaotic financial world. Subscribe if you are ready to treat this asset class with the seriousness it demands. Leave a comment telling me if you think fees alone will be enough to save the network. Keep your emotions in check and your strategy sharp. The future belongs to those who prepare for it. I will see you in the next one.